Hello everyone and welcome to our April investment update. Today I'm joined by Ronelle, who is a Senior Investment Director at Investec. Hi Ronelle.
Hi Michael.
Hi, thanks for coming on today, and I understand you've got some slides for us you've put together. As with all of these investment updates, what we look to do is to really consider what's going on from a global macro perspective and the sort of impact this may have on people's day-to-day lives as well as their investments. So this is where I'll hand over to you. So if you're happy to get cracking and take us through your slides, that would be wonderful. And what I'll do is, as we go, interject with any questions I may have and have a bit of a chat.
Fantastic. Thanks very much, Michael, and thanks to the audience for the time today. It's been another interesting quarter for global markets. Once again, the market conditions has been defined by the sharpest rise in interest rates that we've seen for a couple of decades last year. Just moving to the slide. So looking at slide 2, markets experienced significant volatility intra-quarter as investors reassessed their outlook for interest rates. Strong jobs and inflation data in the US caused expectations of rates to move higher in February, which negatively impacted risk assets, but stress in the banking sector caused investors once again to pivot their expectations, anticipating that central banks would have to lower interest rates a lot lower than planned. But just taking a step back and looking at the bigger picture, 2022 marked the end of a 40-year easing cycle, supported by the tailwinds of globalization and deflation. As a result, the global backdrop is changing. Rising global interest rates is now dovetailing with decarbonization and the early signs of deglobalization. And we're beginning to recognize that we are indeed in a new normal. With the speed and magnitude of rate hikes over the last 12 months, fixed income yields are now at their highest levels in the last 10 years and offer an attractive entry point for investors. So despite the poor returns of 2022, we believe this is not the time to abandon the asset class. But with central banks continuing to hike interest rates, despite the market turbulence and banking stress, because of elevated inflation, we believe that these tighter financial conditions will continue to weigh on growth and increase the risks of a recession in developed markets. From a valuation perspective, valuations in the US remain high by historic standards, whilst profits are at an all-time high. Markets appear not to be pricing in the risk of a recession. Hence, we are cautious and remain underweight to the US in client portfolios. Despite the fall in markets in 2022 on these rising or tighter financial conditions and deteriorating growth, consensus earnings estimates for earnings estimates in the US has remained in positive territory. Yet history tells us that earnings can be substantially negative when economies shrink, and there's a growing risk that company earnings could disappoint in 2023. And when you look at the US from a valuation perspective versus markets like Europe and emerging markets, the US continues to trade at elevated valuation, and we know that there remains heightened earnings risk. So we continue to believe that the US is overvalued. And just moving over to Europe, despite the cheap valuations in Europe, the bailout of Credit Suisse by UBS has led to tighter lending standards, and this will weigh on growth. This is a time when the economic background in Europe is already vulnerable, with weaknesses in the manufacturing sector and poor consumer confidence. But there are some opportunities, relative value opportunities. We believe the outlook for emerging market remains positive. This is on the back of fundamentals, with valuations being cheap and below long-term averages. If you look on price to book levels, emerging markets are trading well below the long-term average. And if you look at where we are in terms of the Asian recovery, we can see that the Asian area is now beginning to stabilize from the COVID lockdowns, and starting to stabilize and position for recovery, which should bode well for risk assets going forward. Added to this, the reopening of China underpins the positive picture for emerging markets, given the health of household finances, and this is reflected in the excess savings that households have at the moment. But in reality, I think we need to recognize that the post-pandemic era has increased uncertainty in markets. If you look at the chart on the right, it shows the number of 1%, 2%, and 3% daily moves in markets post-COVID. And these daily moves are well above historic averages, which thus, with heightened volatility and earnings risk, we continue to see benefits in investing in alternatives. And given this backdrop of a new normal in interest rates and inflation, combined with increased volatility and the risk of recession, we believe that this is a favorable time for active management, as demonstrated in 2022, when active managers have outperformed passive funds. And we believe that investors are being paid to be more considered in this more challenging macroeconomic backdrop. I think when it comes to investing in markets, it's always important to keep the long-term picture in context. And despite the volatility and uncertainty, one must always remember that on average, bear markets last shorter than bull markets, and time in the markets always pays off. And if you look at the latest long-term capital market expectations from JP Morgan for 2023, with valuations have come down as a result of the derating of risk assets in 2022, we now have a better starting point for valuations in 2023. And as a result, the outlook for risk assets is a lot more positive.
Great. Ronelle, thanks for that. So just to summarize really what you've gone through today. So you started off talking about interest rates, and that a couple of months ago, the expectations were that the rates in the United States would peak at a higher level. But actually, because of what's happened with the banking system over the last couple of months, actually it now looks like that's going to drop and the interest rates will cap out a bit sooner than we otherwise anticipated. Is that a fair assessment?
I think that's the expectations of markets.
Okay.
So that is a fair assessment of where markets are at the moment. But I think we also have to recognize that inflation is trending down, but is well above, the average expectations of central bankers at the moment. So rates could be higher for longer.
Sure. So if we're in a position that we're seeing inflation coming down in the US, which is what we have seen over successive months, then that would suggest that interest rates have done the majority of the work they needed to do. And we hope that that trend continues. Obviously, we don't know, but we hope. However, in the UK, it seems to be stubbornly high. And from conversations we've had in the past, the understanding is that the bank issues have been precipitated by the fact that interest rates have gone up so quickly. And that's kind of caught a couple of smaller banks out due to the valuations on bonds and things like that. And obviously, you alluded to the fact that bonds are now seen as good value. So in the UK, what's the general market view is what's going to happen with interest rates? Do they anticipate more rises, or if they do, more gradual rises, or is it a bit uncertain at the moment?
I think what's been interesting about the UK versus the US is that actually inflation has been steadily coming down in the UK, and as a result, expectations for the BOE rates are to continue to move lower. And if you look at the latest forecasts from the IMF, they expect the UK to actually shrink with an output of 0.3% in 2023. So there is a favorable backdrop with inflation moving lower and a weaker economic outlook for the BOE to consider pausing in their interest rate hikes and anticipating, that the next move to be lower. But I think at this stage, given that core CPI is going to be at the 6% level, that's still, inflation is still relatively high. And I think there's a likelihood that, interest rates will remain higher for longer.
Okay, so what we've tried to do in the past is to differentiate between and this might not technically be the correct terminology, but through imported inflation versus domestic inflation. And sort of my interpretation of that is your gas and oil prices is sort of imported because we're importing a lot of the gas and oil for our energy. Obviously, there's then also the foreign currency issues around maybe the pound not being as strong against the dollar and things like that. So that for me is imported. And when we look at inflation, you've got a big slug of it is down to the gas and oil. And then we sort of have a more domestic linked inflation, which could still be linked to those things, but for example, food prices and stuff that is more related to what's going on in this country here ourselves. So is that why interest rates are likely to be up for a bit longer, because our sort of domestic inflation is going to be more stubborn than perhaps what we might start to see a pullback now on gas and oil prices? Because my understanding is they're back to pre-war levels. And so we should hopefully start to see some of a reduction in some of those costs in the coming months?
I think the issue with the domestic economy is that you've still got a very robust services demand, as well as, a tight labor market. So there's still elevated wage pressures, although that is moderating. But I think, it's a tough balancing act at the moment, as you pointed out, with imported inflation coming down, but the domestic inflationary pressure because of a strong services and wages that might keep pressure on inflation for longer. And I think what's also interesting about the UK backdrop is the industrial action, in terms of increased wage demands. So there remains pressure on domestic inflation.
Sure. Okay. And so where do we see the value or the opportunities are likely to come? I mean, one of the things you mentioned there at the end is, bull markets, they're painful when we're going through them. And I think we're certainly obviously experiencing that still now. But hopefully when things start to turn and we move more towards, I just got that the wrong way around, a bear market, apology. We're at the back end of that, but a bull market is obviously a far longer in its time frame. Are there sort of green shoots of hope that we might be moving more towards? I guess what I'm trying to say is, are you more optimistic that we are moving in the right direction and hopefully this is the beginning of a bull market to come?
I think what we got to acknowledge is that the good news is that the bulk of the hiking cycle is now behind us. So that is indeed a positive. The sharp rates of interest rates in the last 12 months and the shock that it has been to the economy is largely behind us. So that is indeed a positive. And we are probably, closer to the cutting of interest rates from this point, and that is always going to be positive for risk assets. In addition, as we mentioned in the presentation, the Chinese economy is coming back on stream, and that's always supportive for the global economy. And that is another tailwind, that could contribute to an improved environment for risk assets as we move forward.
Great. Now, we touched on briefly what your thoughts were on China, and that there seems to be sort of savings in China that you felt would possibly be deployed, and that emerging markets, there's going to be value in those areas. There is concern with China that they may start dabbling in Taiwan, or maybe trying to, get involved in the Ukraine-Russian war. From a markets and investment perspective, are they concerned about that? Have they priced that in? Do they think that Xi's got enough on his plate, domestically, that he's not going to really be getting involved in other areas? What are your thoughts on that?
I think the market may not have fully priced in, any attempts by China to, to claim or to get more involved in Taiwan, or to impact the independence of Taiwan. So that's definitely not reflected in markets at the moment. But I think what we got to recognize, and this is coming from a latest update from the IMF, is that the global economy, in terms of foreign direct investment, is already beginning to fragment to some degree because of these geopolitical economic risks. So if you go back to 2018, when you had the US-China trade war, foreign direct investment to China in some of the key strategic sectors was actually still positive. But post 2018, and since the beginning of the China-US trade war, foreign direct investment in China has now moved decisively negative. And this is because of, national security risks, and obviously China starting to emerge more powerfully in terms of being an economic actor and on the global stage. So we have seen in the real economy a real effect of geopolitics and the fragmentation of foreign direct investment into China. So the market hasn't fully priced these risks of China taking over Taiwan into risk assets as yet, but the real economy since 2018 has begun to reflect this.
Great. So this is sort of following through on the views that there is an element of deglobalization going on. And I guess this sort of plays into the thoughts about energy security, and that sort of ESG portfolios, or maybe more sustainable portfolios, are focusing more on how we create our own energy, look after it, and have energy independence. Because I think globalization was seen once as the way to stop hopeful global fallout and global wars. But actually what we've seen through COVID and obviously the Ukraine war is a fragility that I guess wasn't expected in some way. And so almost there's an element of coming back to, okay, we've got to make sure we're protected as different countries, and that the main infrastructure is protected. And who knows, I guess things may change as things settle down and as time moves forward and opportunity presents itself. Great. So ultimately, just to summarize, could you just give us an idea of how you think 2023, the rest of 2023, because we're already in April, is likely to play out?
I think there's a risk, that from a real economy's perspective, that the sharp move in interest rates hasn't fully been reflected. And we should see, the real impact of these higher interest rates begin to affect economies, consumer confidence, service sector robustness going forward. So we think that, there's still pain to come in terms of the real economy. But from a market perspective, if, inflation declines and central banks begin to consider cutting interest rates, then this may be a positive environment for risk assets going forward.
Fantastic. That's great. Ronelle, thank you very much for your time. Really appreciate the overview. And everyone, thanks for tuning in, and we'll see you next month for our May update. Thank you. Cheers, Ronelle.